So in Warren Buffett's base case scenario, his preferred dividends, at least in the base case scenario where he assumed the growth was consistent as the prior year, equal to the growth that's been predicted on the street on average. Remember, the average depreciation on the street is 0.4% versus what we had as 1%. Sorry, what the difference was in the proxy, the management expectations were upwards of 5.5% growth. So we took a conservative case, or we took a more aggressive case. In that conservative case, there's not enough cash for Warren Buffett to pay his expected annual 9% dividend on his preferred security. So that 9% dividend becomes $720 million per year. So what happens if he can't pay that down? We have to assume he gets deferred. So how does that work? How do we model that in? And we started thinking about it, talking about it. So just to give you an overview, in the last phases of this class, after going through this for 12 weeks, I'll go through this relatively quickly. So for you guys coming and visiting, this might seem like, wow, crazy. Or maybe not. Maybe it's easy. But let's still talk it out. And I want to go through the switches and things like that. I want to go through this. I want to go through the capitalization and amortization of debt fees. I want to go through modeling out a paid in kind security. Maybe have time for some more advanced Excel tomorrow, and then tomorrow I want to go through 2 case studies between tomorrow and Thursday. Final round case studies, model case studies. I want to send them to you and walk through them. So, okay, this is where we're at. So in this acquisition, to refresh your memory, $28 billion was the purchase price. And we had assumed that 30% of the equity would go to Warren Buffett and 70% to 3G. And the returns, we said to 3G in this scenario was 26%. So let's see what scenario we're running. It must be this is the downside. Why is the downside so high? That's the upside. This is oh, sorry, this is a different Dropbox doing something different. So here, upside average in our true downside, where the revenue is 0%, the returns are extremely low. There's I believe no cash available. Let's see where the cash is coming from to pay his annual distributions. Yeah, and so a revolver has to kick in to fund that, to fund his distributions. So what happens in that scenario? In that scenario, we should assume those distributions are deferred and paid until the end. So what we had done, if you remember in the returns, is we said, well, let's forget about that. Let's just assume that his preferred dividends are going to be paid in at the end. It's a hard code. Let's have a formula that kind of leverages between the two. You know? So how do you think about this? We want a switch that toggles between cash paid out annually and deferring those dividends until the end. What does that mean? So right now, we're saying, all right, well, his preferred dividends are being removed from common equity. They're being reserved for him until the end. The problem with this is, in the Financials tab, we have the dividends being paid out annually. So we're kind of double counting dividends. So we need a switch that says either they pay out annually, and if they pay out annually, great, they pay out annually, they impact the cash, etc. Or they don't pay out annually, this is zeroed out and becomes a liability and gets deferred until the end. Yeah, George. You could use if statements. You could let's do it with you could do 1 or 0 binary switch.
So you're
Yes, but what are you multiplying?
The switch. So you have a sum. And it's a sum, and then you have this switch. On one end, it's like, so like you could be like, okay, so create the switch.
Okay.
And then, so you want to say in the other cell or the other sheet.
Okay.
So let's say like equals.
Uh-huh.
And then you want to go to, the year that you want to pay it off. So where is that set explanation?
It actually started on the income statement. This is what drives it. Yep.
So it could be like equals J46 times the switch plus.
Mm-hmm.
And then the plus is 1 minus the switch.
Mm-hmm.
Times.
Well, let's think about it this way, because switch or no switch, what are we trying to do? Maybe we're getting kind of confused with. Right now we have the income statement that has 720 for dividends being paid out, right? And we have net income for dividends. Right? Net income is, let's say, 0. Just to keep it simple. What happens in the cash flow statement? How does this flow through? You guys remember?
Dividends go into financing activities.
Dividends go into financing activities of 720 as being paid out. So what's the cash effect? Negative 720. Right? So cash is negative 720, which means it's this net income that drives the cash flow. Right? So how does cash drive the balance sheet? Well, cash goes down by 720, and this is the problem, right? Because in a conservative scenario, we don't have the cash to be reduced by that amount. We have, where does this go? Here's the preferred dividends.
Retained earnings.
Yep, retained earnings. This goes into retained earnings, 720, and this is how it balances. Net income, retained earnings, 720. So that balances. So the question is, and the problem with this is that they don't have the cash to support it. So we need to defer this. So how do we defer this? How do we defer the preferred dividends? And then we'll talk about how to switch it.
Defer that.
What do you think? What do we want a deferred preferred dividend to do? Huh?
Zero currency.
What do you mean 0?
You're not paying out in cash.
Yes. So what do you mean 0? You're doing more than just not paying it out, right? You're building a liability.
Oh, I see. So instead of going into cash, it's creating a new account.
It's creating a new account.
Dividends payable.
Dividends payable. And what drives dividends payable? What part of it?
Well, it didn't have to be 0. If you have enough money, then maybe going to
Yeah.
You need a new account on the cash receipt.
Yes. So you need a account that almost acts like a debt that creates the liability. You'd almost need a second dividend payable account. You can't just zero this. And that's the thing. If you zero this, then nothing will impact retained earnings. There's still an impact to retained earnings because the dividends have been incurred. They just may not be paid in cash. There's a difference between dividends incurred and dividends actually paid. Two separate actions. So you almost need a preferred dividend payable at 720. That will offset this. That would make the cash zero. Cash zero. And that preferred dividend payable will build the liability of 720. And then it balances. So you need to build a payable account, much like an accounts payable, but it's long term. 9% of Warren Buffett's investment. That was in the proxy. Mm-hmm. That was from last week. So let's model out the payable first, and then we'll put the switch in. How do we model out the payable? Well, we need to add this line. We need to add this line that offsets, because right now, the idea is, all right, well, if you're paying it straight out, it's kicking in the revolver because it doesn't have enough cash to pay it. It's actually exceeding the revolver. So I'm going to add a line called dividends payable. So I'm going to add a line above 97. I'm going to call it dividends payable, which will be 0 in the historical years. And I'll just have it be the 720. So take a second. 0 historical years, have it be 720, have it build the liability. So this is just the historicals. That's just, it never existed before. Right now, I'm just going to make it negative what the dividends were. Right? It's always going to be the same amount. So I'm going to make it negative what the dividends were. It shouldn't be blue. It should be black because it's a formula. And that's basically going to offset, make sure it totals. And you want to also make sure, so it's still kicking in the revolver because it needs to be included in the dividends, the cash before debt pay down formula. It needs to be, it's cash. So in this cash before debt pay down formula, we need to tack in the 720. There you go. And so now the revolver goes away because that requirement doesn't exist anymore. But the balance sheet won't balance. Why will the balance sheet not balance? Because there's a payable that hasn't been recorded in the balance sheet. So we need to add a line for dividends payable. You could put it under anywhere. I'll put it under deferred income taxes. I don't know. I'll call it dividend payable. And in the first year, it's 0. And in the second year, it'll start to build. Right? This is the historical year that came from our pro forma analysis. So maybe to be completely accurate, I should add this row in the pro forma analysis and hard code it 0 up there, but it's all right for now. I'll just make it 0. Make it blue. I don't know if the internet is slowing down or that keeps doing that. And this is going to be equal to the year before plus the dividend, like any liability that we've been doing over the past 12 weeks. Plus the liability, so this is the final cash flow statement line item that should be linked to the balance sheet. It balances, and remember, this is the total that's been accumulated over time, assuming that he doesn't pay it out. Yeah. So now when we go to the returns, we can be a little bit more accurate. If you remember in the returns, we just hard-coded the 9% times Warren Buffett's investment times 5 years because we didn't have his preferred dividends modeled. Now that we have it modeled, we can just link the preferred dividends in from that payable account. We have it building, right? So we can link this in from as negative 3,600. Liabilities. Oops. So it's the same number, but now it just flows through. So we can now run a scenario where if we decide not to defer those payables, right? If we decide to pay in cash, this will be zero. The liability will not be there, and then it'll be zero in the returns tab, which is what we want, right? It's either paying in cash or it's being deferred. And then finally, for the returns here, 3,600, it still links up to before. So now this is flowing more accurately. Now this is flowing completely. So the question is, how do we put in a switch that will turn this off? A switch that says, I don't want to defer anymore, I want to pay it down. Right, so here. So if you don't want to pay it down anymore, what changes on the board here? If you don't want to defer it anymore, what changes on the board? What do you think? What's the difference? Nothing? You don't know? What's the difference? I mean, you talked about how to change it to put it on. How do you reverse it? Yeah. Yeah. You guys agree? Yeah. I mean, it's just a matter of this line. This goes to zero. This goes to zero. David.
If I could use base whether or not you have a dividend payable off of your cash flow for that payment. So if that cash flow is hardly greater than the payable number that you draw.
You could. You could. You could. Yeah. Yeah. So right now, so in other words, just from the highest level, the switch is going to impact this. Either this is zero or this is active, meaning it links to negative this. That was my point. Try to simplify that. Yes. Right now, we're just going to have a hard-coded binary switch. We choose. Should we use it or not, 1 or 0? But you can say, well, this happens if the cash available to pay down debt is greater than 720. You could do it that way. Or you can have an actual dividends payable buried into your debt schedule as a tiered debt line item like any other revolver. I think that's what you're saying, like any other revolving line of credit or any other debt, and say, pay it down if and when possible, if not defer it. But usually, well, I guess it could be piecemeal like that. Usually he'd make the decision if he's going to receive it when available or just defer it at the end and maybe receive some options or warrants. But yes, there are several ways to do that. Yeah, good point. Yeah, you can actually just look at this now as debt, another liability, another loan. and put it into your debt schedule and prioritize it. Either way, I think the point that I wanted to make is it's done here. This is the variable. This is the variable. Right? So when asking for where the switch should go, I mean, it can go into many places, but let's put it here, the dividends payable. Right? This is active if you want to defer. It's zero if you don't want to defer. If you zero this, right, this goes to zero, negative 720, cash is negative 720, cash is negative 720, and then this is zero. Question on that? So let's have a switch. I can go either way, turn on if it's payable or turn on if it's not payable. I would say dividends just off the top of my head, and this is how we did it in the book. Payable. 1 is yes, 0 is no. Let's just do it that way. If that's the case, how do we model it in? How do we utilize that switch? Yeah, Kevin.
So you can like multiple those 720 by,
Yeah.
but it's very durable.
Yep.
Let's say 1.
Yep.
And so in your cash balance, you have the original one plus 720 times the variable. So when it is times 1 minus this number.
Mm-hmm.
So when it's 1, then the item in the cash balance should be 0.
Yep.
But here the dividend variable should be.
Yeah. So here, let's say it's pay. If the switch is 1, then yes, it's payable. If it's 0, then not. So right now, here we want this to be active. So we'll multiply this by the switch anchor, which means whatever formula this is, just multiply it by 1. Don't change anything. Right? You multiply it by 1. Don't change anything. Right? If it's 0, then that'll go to 0. And what happens when that goes to 0? Revolver kicks in now. It's got to pay it in cash. The liability, if you've noticed, dividends payable, is now back to 0. It's not building the liability. Right? So, and it balances. Right? So you've shifted from paying to staying flat. But the problem here is we need to add a little something in the returns. So when it's not payable anymore, it doesn't accumulate. That's great. It's paying out in the cash. It's buried in the cash. See, the minimum cash balance is 100 because we've paid out more than what we were able to handle. And we're actually even raising debt. So actually the revolver has increased. And these are the returns. Negative, we're in the downside case. The one thing we need to, though, adjust is for Warren Buffett's return, because right now the way his return looks, if you're not deferring the dividends, is this is what he's putting in. He's getting out his 30% of the common equity. He's getting back his preferred equity. He's not getting back accumulated dividends because they're not accumulating. He's been receiving them each year. So to calculate his returns, you want to see the 720 that he's getting each year. So we need to link this in somehow with the switch. Is that what you're talking about, Kevin?
Yeah. So you use 720 times 1.
1 minus the opposite. So in other words, when the switch is 0, then we want to show dividends. Whereas here we said, well, when the switch is 0, we do not want to show anything here. So you multiply the formula by 0. So anything multiplied by 0 becomes 0. But in the returns, when it's 0, we want to show that he's getting paid out annually. So we need to link this to something times 1 minus the switch. So it could be this, although you have to flip the signs, it could be this. I'm going to link it to this. It doesn't matter. This is positive already. It's the 720 times, in parentheses, 1 minus the switch. Yeah, 1 minus the switch. Anchor the reference to the switch. And we can copy this to the right. And we just got to make sure it looks like the sum formula is hard-coded 0. It should be summing. Let me just copy the sum formula to the right. This should be summing everything. So his return goes up a little bit. I mean, that's $720 million a year, right? So when the switch is 0, you're not deferring the dividends. Cash each year, cash each year. When you're deferring, then the cash doesn't come out here. Dividend account accumulates. Dividend account accumulates. Revolver should go to 0 because you're not kicking in the revolver, and they should have some cash. Let's just make sure that that's happening. Dividends payable. So that kicks in. Returns. Revolver went to 0. Whoops. Cash has climbed because it hasn't been used. And he's building the liability. Notice it has almost 0 effect to his IRR. So when we were putting together the analysis and analyzing, well, can he afford paying out the dividends or not? Can he pay it out annually or not? What's the back and forth when thinking about the higher level and what's the impact, what the impact is on his returns? It's minimal. It doesn't matter so much.
When you build the liability, would you want also to incorporate the fact that he's going to get paid on year 5, so that the entire liability goes back to 0 and there's a cash release? Or is that not something?
No. Let's see if they're talking about something. So you're talking about the dividends, no?
Correct. Yeah.
So in this case, when the dividends are deferred, this is where he gets it back, right?
So
That's the liability. I don't know if that's what you're talking about. That gets zeroed out when the switch flips. That's 0. He's not getting it. That handled it. Yeah. Any questions on that? All right, let's talk about capitalization and amortization. All right, have you guys had to deal with capitalizing an asset? You know how to capitalize an asset? What's the point of capitalizing an asset?
Yeah, like when we did M&A for Jan, we capitalize like finance. Not so much.
You do? Okay, good.
But not so much.
Yeah, I want to talk about that now. Why would you want to do that? Yeah, I mean, so we're going to talk about capitalizing financing fees, and we'll talk about why. But the bigger picture is, how do you capitalize and amortize anything? What's something that's always effectively capitalized and amortized in some degree?
It should be related to the matching principle. So if it's an expense and it's related to the revenue, not just for this period, but for a long-term period.
Yeah.
Then you should capitalize that and amortize the expense so that you match the expense with the revenue.
Where do we do that in the income statement? Always. Kind of.
Asset?
What kind of asset?
Long-term?
And you mean depreciation? PP&E to depreciation?
Depreciation should be in the capital statement.
Yep. Where else in the income statement? R&D, you should. Where else? What else? Is there anywhere else? It's not really capitalization, but it's a similar method. You could do capital leases. We did that at Walmart. You're taking the cost of some property and spreading it out over time. Yeah? in relation to the revenue. What's the purpose of it? David? Say it again? Smooth out earnings, tax deductions, and it relates to the matching principle, right? It is more appropriate to match the expenses as revenue is generated. So where do we do that in the income statement always? Did it like the very early on. Not necessarily. That's a different kind of animal, unless it's capitalized leases. It's an other expense, other than what we talked about. It's a big one, very major line item, basic accounting. It's a stretch, so and this isn't like a textbook. Cost of goods sold, right? If you think about, I mean, you don't cost of goods sold is not capitalization and amortization, but it's the same basic idea where you are paying for inventory, yet you're not expensing that inventory at purchase. You're spreading out the cost of that inventory when the revenue associated with that inventory is recorded. So it's, I don't want to mislead you. Cost of goods sold related to inventory is not capitalization and amortization, but it's the same basic principle. It's the same idea. You're trying to match it with revenue. And you want to do that with assets. There's a benefit to want to do that with assets. Number one, it's going back to just the accounting matching principle where it's you want to pace out the expenses in line with the revenue that you're generating. And two, it's a tax deduction benefit, right? Sometimes if you were to expense everything all in one lump sum, you will not be able to reap all the tax benefits of that. So it's better to spread it out over time. So you can do that in a lot of different areas. One area is in financing fees. You are allowed to capitalize and amortize a certain amount of financing fees, and specifically, it's the financing fees related to debt in the transaction only. You can't capitalize and amortize equity portion of finance fees, only debt. Why? Because debt is, you collateralize debt. It's backed against an asset. Equity is risk. So you can, and there's exceptions to that too, Kevin.
Is there another benefit that if you capitalize that, it's going to be your asset, so kind of like boosting your asset for collateral?
I don't know if people would buy that in this specific case, right? Because it would be an intangible asset. David?
Do you explain that further more about how you capitalize the debt financing collateral?
Yeah. So, and the rules can and probably will change at some point, but right now it's you can capitalize and amortize certain fees related to certain types of debts because their debts are securitized. So you can, it's like a capital lease versus an operating lease, right? A capital lease is effectively debt that's backed against an asset. And because it's backed against an asset, then you can amortize that. The fees related to debt is collateralized, it's backed against an asset. So you can capitalize and amortize that. But certain debts, you can't do it to some super high yield debt that's not backed against an asset. You probably cannot capitalize and amortize that. There's no security there. So you can capitalize and amortize usually term A loan fees. You got to think about that stuff. Can't do it on equity fees. I don't know. Maybe the rules changed this summer, but other than that, can't do it. So how do you do it? Well, you have to convert it into an asset, and then there's new amortization that goes along with that. So first thing you want to do when you capitalize and amortize those fees, well, we'll talk through the income statements, but first is the balance sheet impact, is on the assumptions tab, we want to figure out how many fees are we paying, and so the specific case that we're running is 138.1.1, right? So let's say these are all the fees. You can't capitalize all the fees. You can only capitalize the fees related to the debts. And so just let's assume that, the fees related to debts is 1% on the term and 1% on the notes. These are collateralized. So let's say 1% on the term and 1% on the notes are fees related to debts. So let's say debt-related fees. And just to have something in the assumptions. And we're just going to say 1% times 10.5, whoops, 10.5 plus 2.1, 126. I mean, it's arbitrary right now what that number is, but just note that that's a subset of the total fees. It's not additional fees. It's a subset of the 1381. So in other words, what you really should do in an actual transaction is have a table that say, all right, well, 1381 are the fees that you modeled. How did you get there? You had debt-related fees. I guess we could do it here. Total fees. You had a bunch of other fees, and we'll do this in the balance sheet. This is the remainder, right? So the total fees are the 1381, right? But the point is, and what I'm just trying to illustrate is that the debt-related fees are a subset of the total fees, not in addition to. This is all we're allowed to capitalize and amortize. So how do we do it? Well, this becomes an asset, right? So we'll create an asset called debt-related capitalized debt fees. Where would that go? Where would you begin? There's two things going on. There's the balance sheet aspect, there's putting it up on the balance sheet, and then there's amortizing it, just like buying an asset. So let's start with putting the asset up. Where do we begin in putting up the asset? Yes, inherently. Which goes where? Say again? It's an asset. It's an asset. Intangible asset. And which schedule? Where do we begin? Where could we begin? Whoop. Balance sheet adjustment. Absolutely. Transaction adjustment. This is a transaction adjustment. Yeah? So we can, if you want to lump it into, yeah, I guess we can consider it other intangibles. I forgot how I did it in the book as a separate line item. Let's just to be clear, I'm going to put it as a separate line item. And I'm going to call it capitalized debt fee. Which is zero historically, and the fee comes in and builds up an asset that will slowly deplete over time. It'll deplete as it's being used and expensed to defer taxes. That's the idea of capitalizing and amortizing. It's important to know how to capitalize and amortize. Yeah, I got a case study on this once when I was interviewing private equity. Here's a model. How do you capitalize and amortize this? Important to go through. So this was zero. And you pull in what you're capitalizing, the debt-related fee, into your balance sheet. And but when you do that, your balance sheet does not balance. Why does it not balance? Yeah, you're basically double counting fees, right? On your assumptions tab, what we've done is we've reduced goodwill by the 1381. We now only want to reduce, retained earnings. We now only want to reduce retained earnings by this 1255 basically. just the equity portion. This is the portion you're not capitalizing and amortizing. This will come into your shareholders' equity as it's being expensed, as it's hitting net income over time. So instead of hitting the 13,801 in one lump sum, you're just hitting the 1255, and then that remaining 126 that we've capitalized will go into your shareholders' equity over time. Yeah? Okay with that? So in the financials, instead of what we typically do, which is reduce retained earnings by the total fees, we're only going to reduce retained earnings by the portion of the fees that are not related to debts. So we've moved a portion of those debt fees from hitting the income right away up to an asset that will deplete over time. But your balance sheet doesn't balance because we need to add that line item into your true balance sheet, which we put other non-current assets. And I'm just going to call this capitalized debt fees. Yeah, that should balance. And then we have a little problem here. We need to, this is flat. I don't know where that came from. Yeah, it's not changing yet. It will change as we amortize. Yeah. So now we amortize, we pull through. So how do we amortize? The amortization of capitalized fees is spread out over the life of the transaction only, 5 years. Right? So the amortized fees over the life of the transaction. So I'm just going to hard code it in, but make sure you know that. And that'll flow through amortization into net income, just like we do depreciation and amortization, right? Into reduce the capitalized debt fees, etc. So how do we do that? Where do we go? You save this. Where do we begin for that? Depreciation and amortization. Could do the depreciation and amortization schedule, where we have already amortization of the existing intangibles, amortization of the identifiable intangible assets from the goodwill, and then amortization of capitalized debt fees, which I'll just say I'm just going to hard code here, it's that 126 divided by 5, spread out over 5 years, over the life of the transaction. Right? You okay with that? Like the lenders wouldn't let you extend beyond that. They want their money back. Equals the debt-related fees, I'll anchor divided by 5, which is 25, and I'll copy this to the right. Right? So the idea is this is just an additional depreciation amortization expense. of which that amortization will go into the income statement, cash statement, balance sheet. So on the income statement, we have additional amortization. We already have the depreciation, amortization, the amortization of identifiable intangible assets, and I'm going to add the amortization of capitalized debt fees, which is 0 historically, and then they're going to come from the depreciation table up above, down below. Which is just what we had modeled down here, copied it down. This is the, want to make sure it adds in, the additional debt fee capitalization. The expense goes up, you're saving on interest payments. This gets reversed in the cash flow statement like any amortization expense. We've done this a million times. So I'll go through it quickly, which is the amortization capitalized debt fee. Then where does that go? Additional cash statement line item has to go where? Balance sheet. So we'll have to reduce that 126 expense. It'll be, needs to hit by 0 by exit. So this is just what we've had before. Want to make sure that that totals in. Yes. And then the balance sheet is now going to be out of balance because we have another expense, 126, that we need to reduce by the new debt fee, which is here. And in 5 years, that should go to 0. It's been paid off. We now balance, that's been capitalized. Any questions on that? I mean, I ran through the amortization part of it because we've put amortization in a model a lot of times. Yes, David. What do you mean the initial expense of the fee?
The initial negative cash flow.
No, we didn't do that at all because that's pre-2014. So our cash flow recorded is just 2014. So that payout is done before the model's been projected. If I were to, which I didn't choose to do that in the model, if I were to put in a 2013, out of court how that changes hands. You mean the where this gets paid? Yeah. Good point though. But the actual cash payout, the check being written, you wouldn't see in the next year. You would see it in LTM, which you didn't model. Good point though. Any other question on that stuff? I definitely want to at least cover it once, so if you get asked, we went through it. It's in the book. All right, let's take a break. I want to finally model out a paid in kind security. That's just another thing that's been, people get asked. It's very simple. So it's an easy thing to know, and it's better to know it than not to know it. And we'll take it from there. Paid in kind securities. Have you heard about them? Have you had to deal with them yet? Or no? Not at all? They are kind of, well, last year they were kind of getting hot, and then I just stopped hearing about them this year. But, you know, they are somewhat of a replacement for a high yield type of lending, a super high yield type of lending, where the interest incurred on the debt is not paid out in cash. You borrow more money to pay the interest on the debt. So there's interest on interest. It's very expensive. And usually you don't PIK, they call it the PIK, they use it as a verb, 100% of the interest. So you'll have a security that maybe has 15% interest, of which 3% is PIKed, the rest is paid in cash. So it's just an additional incentive to the company that's receiving this debt to say, well, it doesn't have to hurt their cash flow as much. To the lender, they're able to squeeze out an additional 3%, and it's deferred, so there's interest on interest. So the question is, how do you model it? And the reason why I'm bringing this up is because there's kind of been a bit of resurgence. People have been asked about it, and people have been asked to model it. So it's important to, you might not get that, and it's more private equity, but if you can talk about it, if you say you can talk about it, then it would just be better. So, yes?
Why would you actually go for that create yourself like interest that you have to pay, like interest and interest? I mean, it's pretty much expensive.
It just all goes back to the idea that you want to put in as little equity as possible to maximize your returns. You know, if the additional 3% would allow you to do the deal that would reap you 25% returns, then they would take that cost. I think that's the best way I can put it. And they'd only do it if that's all they can get. And these days that might be all you can get.
But they never use it like finding something like
No, I wouldn't see, only in an aggressive environment like this, I wouldn't say, all right, well, we need to buy a bunch of equipment, let's use paid in kind securities to do that. I wouldn't think so. Anything is possible, but then yeah, and from that perspective, it's too costly. Right? I mean, this is uncollateralized typically. If it's equipment, things like that, that's collateralized, why get into that? Good question. So the way it works, real simple, let's model one out so you have it on record, is I'm just going to assume that these notes have now become a high yield debt that has a paid in kind security attached. So in other words, let's just say, just to keep it straightforward, the 7.5% of notes is not paid in cash, but paid in kind. Right? So what happens when it's paid in kind? Well, real simple. This 157 now actually adds to the ending debt balance. It becomes your new balance. There's a couple ways to do it, but what I would do is just add a row underneath the 7.5. And what I would just say, actually, I'm going to call this I would just call this the notes after paid in kind. Right, so we have this 157, and they say, okay, I'm not going to pay that 157 in cash. I'm going to actually increase my debt balance to fund that. So what happens is you take the 2100, the bottom balance, and you add the 157. You're increasing your balance at the bottom. Yeah. And that's the new balance. So the new balance at the beginning of the year is not this 2100, it's the new available 25275. So it is literally interest on interest. I copy everything to the right, and you can see how the interest is actually climbing each year because there's interest on the new balance. Interest on interest. That's how it works. But it's not that simple because we need to figure out what happens to the income statement, cash flow statement, and balance sheet. Why? Why is the income statement, cash statement, balance sheet a concern?
Because you're not paying down interest, which is going to be shown.
Right. Does it go on the income statement and cash statement? Does it? Say again?
Because net income will factor the interest cost, which is not being done.
Would it? How do you know? Is PIK interest tax deductible? Is it interest or is it debt? PIK interest tax deductible. Is it interest or is it debt? Depends. Depends on the security, the jurisdiction that your company has been incorporated in, if it's admissible. It may or may not be. Sometimes it is, sometimes it isn't. You have to get a tax lawyer to figure that out. What difference does it make? If it's tax deductible, let's assume the simpler. It's tax deductible. What happens? This is the complexity of paid in kind securities. It's tax deductible. What happens? Impacts your net income. Flows into your income statement. Impacts net income. Then what happens? What happens to your cash flow? So right now it's doing that, right? This still totals as always into your total interest. That goes to your income statement. Nothing's changed. Interest on your income statement has increased. Nothing's changed. Impacts your net income. Goes into your cash flow statement. What else happens on a paid in kind security? So, PIK interest. Tax deductible? Yes, it's tax deductible. Let's say it's 100. We'll do 40 taxes. Right. PIK. Tax and income. Impacts net income on the cash flow. Now what happens? The PIK interest expense acts as a liability. It needs to build a liability that will become a payable upon exit. So what do you need to do? Babinski. Yeah. So we'll add it back. Is it an operating activity or is it a finance activity? Why?
Funding the business.
Okay. But is normal interest operating or financing? Operating. So why is it not operating? No, I'm not. I'm challenging.
I always thought it was the way you're kind of funding the business, so.
It's a debate. Why is interest expense operating and not financing? Winsky.
What I know is it could be either, like, it
Yeah.
depends on the system you use, so.
Yeah.
Half I think it could be either operating or investing, and then for IFRS, it's operating or financing.
Yeah, actually, consultants take it out. If anyone has worked at, like a McKinsey. So, in the GAAP, you typically treat it as operating. And the idea is that the debt raised and the interest incurred in that debt has been used to produce some sort of operations. But it's been a debate. It's been a debate. And so we don't adjust it in the operating activities. Interest expense is part of operating activities right here. In consulting, you would always, any interest expense, you'd pull it out, you add it back here, and then you'd remove it in the financing activities. So that's what sometimes you do. That's the other belief there is, well, interest is debt is financing. So that's been the debate. The problem with the paid in kind security, though, is that it's unique to interest in that it is also creating a payable account. It is also creating a loan. So it's more of a hybrid than just straight up interest. So I don't know. I've seen it done both ways. Yeah.
But wouldn't the more conservative approach be to treat it as operating?
PIK?
Interest expense.
Why is that conservative?
Because if you add it back in your inflating your CFO,
You're saying it?
if you add it back in the cash flow from operations, then you're gonna inflate your free cash flow or increase it. I mean,
Yeah.
unless you have a lot of cash.
Yeah, I mean, I guess you could see it that way. It just depends on. I envision cash from operations more as EBITDA. Yeah, I mean,
So it's
I don't know. I mean, this is the debate. So you have a good point. This is go back and forth still. There's no resolution on it. Right? I mean, there is to the extent that this is the way we're doing it. We've been doing it now and for quite a few years, but there is a pushback on that, especially from consulting and operators that say, well, no, it's it's a low. So yeah, from that perspective, yeah, I guess that would be conservative. You make a good point. You make a good argument. So we could put it anywhere. I don't remember which way I did in the book, but I literally go back and forth. I mean, either way, it's got to be an add back. I think I put it in the financing activities. I don't remember. Either way, it's going to increase cash. 100 comes back, and then it becomes 40. Tax savings. You got the tax savings. That's what you want. You got your tax savings. This gets added back because it impacts your debt. So net income, sorry, cash. So your cash is up by 40. Your net income, tax impact hits retained earnings. And this becomes a liability, paid in kind, payable of 100. That's how you model it out. Assuming it's not tax deductible. Sorry, assuming it is tax deductible. So We'll need to add it back. I'm going to add a line in the financing activities. It's a toss-up. If you were to put it in the operating activities, I've seen it done both ways in models. So I got this dividends payable. I'm going to add to this paid in kind. You can be more descriptive if you want to. And we'll link it in from the interest that's been paid in kind. So I'm going to bring this in as 0. And the paid in kind is going to just link in. I'll link it in from the actual interest that's been deferred, the 1575. That's what's paid in kind. And because it's debt, I just want to be sure that it's excluded. It's continued to be excluded. It's debt now. From the cash before debt pay down. And we're going to have a balancing problem again. Right? So I want to add an additional paid in kind. I'll put it under the notes. Line item to deal with the increase of that expense. So I'll just make it 0 here, and it's going to be the year before plus that cash flow line item. Paid in kind. Right, so the balance is increasing, and we should balance. Yes?
So why don't we just do this revolver to raise more of that from the revolver to pay down the interest?
Oh, you could have. You could have, but
Because that's cheaper.
yeah, you could have. I'm just, yeah, I mean, in this particular case, it would have been cheaper to do that. You could have. I'm just trying to show you how to model it. I mean, this has not been done in the deal. I'm just doing this on this model just so I can show you how it's done. Yeah.
If we just use revolver to pay down interest rate, then there shouldn't be any.
No liability. Correct. Yep. You're right.
But is it still kind of like 85?
No. No. Then you're just paying the interest like you normally are. Then it's not a PIK at all. You're just saying, why don't PIK, just pay down the interest. Sure.
Can you explain why we feel
It's another way to get a more aggressive type of lending. It's another way to get it's a high yield type of lending. So if you want to try to raise and maximize as much debt as you can in order to minimize the equity that you put into the business, then if that's what they're offering, you'll take it.
What's the level of an interest rate on the PIK?
15% was the example I gave before. That's kind of common. So 12% cash, 3% PIKed, anywhere up to 25%. Although 25 is pretty rare and aggressive. I've seen maybe 22, 20, 22, often 15. Good question. Okay, we're not done yet though. Because we want to make sure, impact our returns. Proof that in a second. To impact our returns, we need to add a row to represent the PIK. Less PIK. Yeah. We need to add that payout. That's now debt that needs to be paid. So this is going to be equal to the balance that we have outstanding, right? At the end, we now have, I know what's going on down there. I got to fix that in a second. We have, what is it? Where do we build it up? The 886.3 that's been built up. All the accumulated interest now has to be deferred and minus paid out at the end. Which will reduce the equity to common. Yes. Any questions on that? So what if it's not tax deductible? I don't think I put that in the book. What if it's not tax deductible? How do you deal with it?
You just treat it as a move out, you know, whether it should be, there shouldn't be any factor in your income statement.
Yeah. So how do we do that? How do we do that with a switch? What's changed? Up here. David? Say again?
In the debt schedule, the payment in kind securities, there should be a link between the interest expense of that and the income statement. So if we zero that link, we'll break the chain.
Yep.
I'm assuming that the cash flow statement adds back another link to the income statement. So we zero that link, the initial link, and then we just zero.
So you zero this. Then this is zero, and this is zero. Okay.
So effectively, all we've done is raise debt and interest on our debt schedule by the cash flow statement.
That zero. That's zero. That's zero. So you'd have a switch that says, right now this links in from basically, this links in from the total interest expense. But what you would do is, what you would do is you would actually link it into revolving line of credit. Oh, well, I'll show you right now. PIK tax deductible. Yep.
Might be wrong. It's not about
Yep.
need the interest rate to be zero, we need only like payable account with interest.
Mm-hmm.
Some liability to offset the increase. And cash flow statement to zero that out. And then we'll have balance sheet.
So what else would you need?
The interest rate.
Well, you have that here. But so what you're saying is, this is 100, and this is 100. It's not 0. Is that okay? Yes.
I think you need some sort of like contract asset. Because you don't really have the cash, you still have the expense, but you get recognized on the expense, but you still technically have to pay back the interest. But you don't, there has to be something on the asset.
There's something. Might not be an asset.
No, even our name, income statement. After the income.
Yeah. Yeah, you do.
What's that?
It's pretty good. What line do you need? You don't need, so the way to think about it is, I see that where you're thinking about it is to offset the asset. But the problem is the cash shouldn't be 100, the cash should be 0. So you need to offset net income. Right? So how would you do it? If you offset net income, then cash should be 0. And this would be 0. And then you want retained earnings to be impacted. Right? So how would you do it? So you want, like, a PIK to be here. Yeah? And then what? Now there's 2 ways to do it. There's a couple ways to do it, but. You thinking about it?
Yeah.
Okay. Does this give a clue? So you're not wiping it out altogether. You're bringing it down here as if it was a distribution. You could do it that way, where there's a net income after PIK. Right? I'll have to add that. That's negative 100. Which means this net income becomes negative 100. And that net income goes into retained earnings. Retained earnings becomes negative 100. And that balances. Or you could have just kept the same net income and just had another PIK line that brought your operations down to 100. That would flow into your retained earnings.
Yeah, could you just like make this like just like an if statement where like if it is tax deductible, throw it, or if it is tax deductible, put it up above net income. If it's not, then put it below,
Yep.
and then just make sure that full lower line flows down to your cash flow.
Otherwise it's 0.
Yeah.
Yep. And make sure that the below line goes into, so the difference is, I should have had better colors here. The difference is, this would exist if it's not tax deductible. This would exist if it's not tax deductible, which automatically flows in here no matter what. If it's not, then this doesn't exist, which means this doesn't exist, but it would have to exist there. So we'd have to create a switch that does that.
You would put that into retained earnings rather than like accumulated other. That's one thing sometimes I'm not sure. Sometimes I get like confusing the retained earnings kind of account where it's like, it's like perfectly it should be just dividends and net income.
I put it in, I put it in accumulated other comprehensive loss.
Yeah.
Paid in kind securities. The problem is I've actually never seen PIK reported in any financial statement. So I don't know if it would be admissible as I don't know, other comprehensive income or retained earnings. You'd have to get, and I don't even know if GAAP had ever seen it. You know what I'm saying? Because it's usually when the company's taken private. But I would argue that it's other comprehensive income, unless it was a distribution, and it's not a distribution. David? Yeah, I mean, it would it could as a non-recurring event, as other comprehensive income. It definitely would offset it in your cash from operations, which is the way we're going to model it.
For tax purposes, you are using the net income for.
Yeah, this gets wiped out. So maybe this will clarify. So in other words, if it's tax deductible, this is what's happening, right? If it's tax deductible, we have the tax deductible case right now. But to separate this, to make sure that when this is zero, it comes out of the income statement, I want to relink this in more detail. I want this to be equal from not the total income, but I want this to be equal from always, right? Always the interest on the revolver plus the interest on the term A plus the PIK only if that switch is 1. So this PIK times the switch. Anchor. Right? So if the PIK tax deductible is 0, it pulls it out. Should have. Why didn't it do that? Oh. I linked it from a different switch. Why did I do that? Thank you. If it's 0, yeah, then it drops by the 157 and continues to drop. It's flat. It's just on the two pieces, right? So if it's tax deductible, fine. It goes through, it gets removed. If it's not tax deductible, what happens? It's not here. So where do we say it comes up? Operating activities, yeah. Operating activities, do we create a line? Let's create a line for it above other items. Tax deductible, non-tax deductible, PIK, which is only active if the switch is 0, right? So this is going to be the PIK from the debt schedule times 1 minus 0. Equals the PIK, tax deductible. Oh, we got to fix that. There it is. Times 1 minus the switch, meaning activate it only if this is 0. There it is. This is a negative, right? That should work. Goes into cash. This will not balance until we now have that impact accumulated other comprehensive loss. That's the way it works. So in other words, if it's 0, it's got to impact something here. Cash from operations to offset the money coming in to make cash 0. Liability is up still. The returns, it still exists. The only difference is the way it impacts taxes. If it is tax deductible, 1, taxes come up here, does not have an additional removal in the cash from operations. That's right, right? This is something else. What happened here? Oh, I need to anchor my formula. That should be 0 all the way through. And the liability increases, doesn't impact the balance sheet, and it's balancing. That's the difference. That's where PIKs get complicated. Any questions on that? Yeah.
So when you subtract the from the operating activities, do you add it back to the financing activities?
Still this is happening.
Okay, so
It's just offsetting. It's just like an offset.
there's no cash change.
There's no cash change. Any question on that?